Hi, I'm Patu from freefincal. I was asked an interesting question by a viewer recently. He wanted to know if the Parak Parik Conservative Hybrid Fund can be used as an alternative for a fixed deposit. It is true that they invest only in government bonds, state government bonds, and dividend stocks like ITC and Coal India, etc. But investing in a government bond will not give you stable returns. It will give you the very opposite of stable returns because most government bonds, typically most funds invest in long-term government bonds, so the NAV will fluctuate quite a bit. So this fund is not safe. So let's look a little on a wider perspective and ask which mutual fund can I use as a fixed deposit replacement. We do this all the time. Technically, a fixed deposit should not be compared with a mutual fund because one is market linked, the other is not. However, we do this all the time. We do replace it because for long term goals from our father's generation, we have shifted from fixed income instruments to equity mutual funds, of course, within an asset allocation and so on. But that is the easy part. For long term goals, we will define it as about 10 years or more. What about short term goals, that is 5 years or less, or medium term goals between 5 to 10 years? What would you use for that? Of course, the experienced investor can, with an appropriate asset allocation, use equity mutual funds or some kind of hybrid funds like aggressive hybrid fund, multi asset hybrid fund to whatever extent they are comfortable. But let's talk about a relatively newer investor with a little experience, what kind of mutual funds they would use. I would recommend not touching equity for anything less than 10 years initially because you are used only for your long term goals. Invest rigorously with a proper asset allocation there. But for short term goals, my recommendation for a newbie is for money you need after 1 year, 2 year, 3 year, simply stick to a nice recurring deposit. That's enough. Maybe if you are interested to learn more about debt mutual funds, first learn it and then you can put money in it because most people don't appreciate the risks in debt mutual funds. So we will talk about a very simple general framework for choosing a debt mutual fund for these kind of goals. So to do that, the first metric I would ask you to look at for a debt mutual fund or even a hybrid fund, this will be applicable, is the average portfolio maturity of the fund. This is the weighted average maturity period of the bonds in the portfolio. Higher this value, higher will be the NAV fluctuations. So a fund with a average portfolio maturity of 5 years or 6 years or 7 years will be a lot more volatile than a fund with, let's say, 0.1 years like a liquid fund, or 0.5 years, 1 year, and so on. So this is the most important metric, the first metric that I that I think you should be seeing. Then the simple thumb rule is, if you want money in 5 years, choose a fund whose typical average portfolio maturity is much less than 5 years. Let's say 1 year. So if you want money in 5 years, you use a fund with average portfolio maturity of 1 year or maybe even less. Many people give the wrong advice that if you want money in 5 years, you should choose a fund with average portfolio maturity of 5 years. This is extraordinarily wrong advice because the fund manager in an open-ended fund will always be continuing to hold funds which are long term, and average means not all the funds will have 5 years. Average 5 years means not all will have 5 years. So some of them will have much higher than that, which means that until you need the goal, until you need the money for the goal, your NAV will be extremely volatile and you could lose money. You could end up losing money, and that's very dangerous. So you should always stick to your average portfolio maturity much less than your goal period. Of course, for long term goals, it doesn't really matter that much. Suppose you want money in 12 years or 15 years or so on, then your average portfolio maturity can be anything. It can be 7 years, 8 years, it doesn't matter. But because anyway you are expecting that volatility, you are going to exploit that volatility by regular rebalancing. There it doesn't matter. For short term and intermediate term goals, it definitely makes a very big difference. Now, then you look at the credit rating. Now, just because some of your fund has got your sovereign credit rating, please remember, sovereign credit rating means it's a separate rating. It is not higher than AAA. Some people make that mistake. Sovereign rating essentially means you cannot rate that fund. It's given by the government. If the government defaults, then all hell will break loose. So it's not higher than AAA. That is a important understanding we must have. Now, just because something is sovereign doesn't mean your NAV will not fluctuate, or you are guaranteed to get return your money back or something like that. That is not true. That's where the average maturity comes into play. Now, the other thing is that how comfortable are you? Suppose the fund invests typically in AAA bonds, but has got about 5% or 10% exposure in AA or A kind of bonds. Are you okay with that? That is something that you should ask yourself, because there are some categories where you can easily find funds which only invest in good quality credit. That is, either it will be AAA for long term or A1 plus for short term. But in many categories, it will be a mixed bag. So I would recommend not investing in such categories. For example, if you are somebody who is very clear that you want to avoid all kind of low rated bonds, then a money market fund or some certain liquid funds are suitable for you. In a money market fund, so far, to whatever extent I have seen, we have a monthly debt mutual fund screener which publishes this data. From whatever I have seen, the credit rating across all the funds in the category, in the money market category, is reasonably good. In the liquid fund category, it is not the case. Some funds can take risky bonds. If you are very adamant, then you have quantum liquid, which is a good bet. You have parak liquid, which is a reasonable bet. Or you can choose the big AMCs like SBI, HDFC, ICICI. They are liquid funds. They also generally will not play around too much with the liquid funds. There also you can you have reasonable safety. You can't have absolute safety, absolute guarantees. I mean, the risk and reward, everything should be reasonable. That's how. Otherwise, you are not. It's not good to. I mean, you are not a suitable fit for mutual funds. Now, with that said, now what would you do? Now, please recognize, even in gilt funds, 20% of the portfolio can be invested in low rated bonds. So there is no such thing as a pure gilt fund. It doesn't exist. It's just that they do it to ensure people are not scared about it and so on. Now, then you have arbitrage funds. Arbitrage funds are also hybrid funds these days. They can also invest about 35% in bonds. You can consider them, but some of them can take risks. So you have to be careful with that. So I would recommend for short-term goals, if you want to avoid the extra tax with recurrent deposits and fixed deposits, you can go for liquid funds or money market funds. You can continue to use money market funds or liquid funds for intermediate term goals also. If you are somebody who doesn't mind a little bit extra risk, you can consider ultra short term. The NAV will be a little bit more volatile, but not too much. Certainly, it doesn't matter over an intermediate term period. But you don't. As far as my observations go, I have not seen a clean ultra short term fund which they say they will only invest in high rated bonds. So that's hard to find. That's the only problem with the ultra short term category. So also, if the interest rates increase, which everybody is expecting these days, then the liquid funds and money market funds and even ultra short term funds will benefit just as much as a floating rate fund, even if not more. So don't get into all this idea about floating rate funds being important and so on. Now, then there is another category called the target maturity funds. I have a separate video on this. So these are open-ended funds, but they have a maturity period. So if an investor starts investing in the NFO period and continues to invest and does not sell in the middle, then there is a reasonable safety, but the returns will not be the same as what it is going to be published in the NFO period. That is wrong. Many people have this fixation of returns, that if you are going to be in that mode, then don't invest in debt funds. Many people say NFO period, the target maturity fund said they will give the 6.5%, therefore my return will be 6.5%. No, that is not going to be the case, because if you are going to invest a large lump sum and you are not going to touch that in the middle, then there is a reasonable chance, but then the bonds in the portfolio can get into trouble. Then there will be a change in the portfolio, then your returns will be different. If you invest in the middle of the fund tenure also, your returns will be different. So this fixation with this fixed deposit mentality should go away when you are investing in debt mutual funds. So these target maturity funds can be used provided the maturity date of the fund and when you need the money coincide to a reasonable extent. Now, with all that said, who should invest in Parak Parik conservative hybrid? So the first step is to look at the average maturity, like we said, and it is 6.35 years as of November 2021. That means you should not use it for short-term goals. I would strongly recommend not using it for intermediate term goals. It is only suitable for long-term goals, and it will go through periods of ups and lows. Already in the short history, it has given 3 months with negative returns. 3 months, negative returns of that fund has been negative. So you should not get into that idea that you are actually replacing it with replacing your fixed deposits with a better instrument. That kind of attitude should never be there with mutual funds. Returns will always fluctuate. You must go from guaranteed returns, guaranteed safety to reasonable returns, reasonable safety, and better taxation. So to understand what is a reasonable safety, you must do some work and study the fund categories. Otherwise, you can't simply say, I'm going to show me a fund, I will invest my money in it. That kind of thing is going to end quite badly. So if you have any questions, please let me know.